Hello, everyone, and once again, welcome to the Smart Investor Podcast, empowering you, the investor, and where smart investors get their up to date price analysis and market information. Well, last week I was listening to the news media, and it seems that everyone is back on the bullish train. S&P 500 turned positive for the year, slightly positive for the year, and the overall feel I got by listening to the various analysts and the various folks I was seeing on the media is that we are back in territory where we don't have to worry again. Recession fears are apparently gone, and we there is nothing to worry about, and the markets will continue going up. That's just the feeling I was getting. Now, what exactly are the prices saying, and what are the prices telling us? But firstly, for those of you who are listening to the podcast and want to actually see the video analysis, you can go to smartinvestorcentral.com and go to market updates where you can see the video analysis and the charts and everything. It gives you a different perspective so you can see exactly what's happening. Okay, in front of me I have a chart of the S&P 500, and we see that S&P 500 has returned positive for the year. And let me just give you a monthly chart. We see we started the year roughly at 2037, and the market closed last week just below 2037, but the high that was made last week was 2043. So we were a couple points into positive territory, but we are currently now slightly below the high that was made of the year. Now, as we have had a good rally off of the 1800 low, and the market has gone up quite nicely, but we're coming up into certain resistance areas where we saw the market near the 2100 level and also the 2050 level experience some resistance in the S&P 500. So we are currently trading up into this resistance area, and it will be definitely interesting to see how the market reacts at this point. Does the bull or the bulls, do they have the energy to push the market up further? Can they do they have enough buying power to push the markets above these resistance areas here? We just all of this 2030 to 2100 is strong resistance. Even above the high is very strong resistance. So you will have a lot of sellers lining up above these levels. So will the buying pressure of the bulls be strong enough to push the market up further, or could we get a decline? Critical resistance is up at 2100. If we start to move above 2100, that would be very bullish, and we could be challenging the highs of the year. The all-time high, which was made in May of last year, which is 2133. Support again comes in at 1800. If we see the market turn to the downside and threaten the 1800 level and close below 1800, that would be very bearish for this market. So essentially the market is still in it's the view is slightly positive at this point in time, but we have to be cautious that we are in this resistance area and the markets could start to decline. So this week will be very interesting to watch and see what happens in the S&P 500. Taking a quick look at the Dow Jones Industrial Average, the Dow Cash Market, we see that the Dow has bounced off of the 15,500 low, and it's coming similar to S&P 500. It's coming up in an area of strong resistance in the just below 18,000. and 17,500. This area here is pretty strong resistance, and if we have the energy to trade above 18,000, that will then challenge the all-time high that was made in the Dow last May, just shy of the 18,400 level in the Dow. Looking at the Nasdaq, and take a look at the Nasdaq futures. Nasdaq is underperforming slightly. The market bounced from the 3,900 level, and it's currently at 4,390, and it's not up in the resistance areas just yet, similar to the S&P 500 and the Dow. Resistance in the Nasdaq starts at around 4,500, up to the 4,700 level in the Nasdaq futures. Overseas, let's take a look at what's happening in the European markets. We see that the London market, the FTSE, has recovered slightly, but we're up in an area of strong resistance, and this chart is seeing lower highs and lower lows. I would say this chart is looking very, very bearish at this point in time, and the bearish momentum will not be broken until we close possibly above the 6,400 or the 6,500 level in the FTSE. Taking a look at the German DAX, again, markets trying to recover. We're seeing a series of lower highs, lower lows ever since the April high, and the market is coming up in resistance at the 9,800 to 10,000 region, where we should see some pretty strong resistance around this point in the German DAX. Looking at the CAC 40, we have resistance markets trading up into resistance up at the 4,600 level. The CAC 40 and the German DAX move similarly and often track each other. Taking a look further overseas, let's take a look at the Nikkei stock index. Again, lower highs, lower lows on the chart, and we are coming up in resistance at the 18,000 level on the Nikkei. Okay, so that's what's happening in the world markets. Looking at all the markets combined, we're coming up into fairly strong resistance areas in most of these indices. So if we can break above these levels, that would be very positive for the markets. If not, and sellers overwhelm the buyers, we could be seeing a downtick in the various indices. Moving on to the US dollar, we see that the US dollar is still fairly range bound, trapped in a broad range that has been essentially frustrating traders of currencies and traders in the US dollar index. Market is stuck between the 100 level and the 93 level in the US dollar index. The US dollar has been losing some steam over the last couple of weeks, where we see the index move down to from 98 down to the 95 level, but still very relatively small movements in the dollar, and traders in currencies are just looking to see where this market will break. Are we at the end of essentially an 8-year bull market in the dollar? Let me just look and tell you that the dollar actually bottomed out in 2008. We can see this chart of US dollar index. The dollar index bottomed just above the 70 level in 2008, and ever since 2008 we have seen a dollar trending, not very much, but trending to the upside, and we're currently at the 95 level. So the dollar has had a huge run over the last 7.5 to 8 years. So the question is, are we at the end of a US dollar bull market? And if we are, we have to then prepare or set our sights out on, will the dollar enter another bear market? The last bear market in the US dollar index was from 2001 to 2008, a 7-year period that saw the dollar lose about 60% of its value from the 120 level down to the 70 level. Sorry, lost just about 40% of its value, not 60. So if we are at a top in the US dollar index, we could over the next couple of years see a bearish move in the markets, but that is yet to be seen just as yet, and we'll just have to wait and see what happens. Taking a look at the gold market, gold is down this morning. Gold is trading up against resistance in the 1300 to 1280 level on the cash gold. Another market that ran up in the last couple of weeks is the crude oil market. Taking a look at the oil futures, we see that the market is coming up into the $40 region and $41 region, and we could see some resistance between the $40 and the $43 or $44 level in crude oil. So we have had a nice recovery off of the bottom, but we're coming up into some resistance points in crude oil, and we could see another leg to the downside in oil. It has not happened yet, but I'm just pointing out what essentially could happen. Okay, so that's essentially it in terms of the price analysis of the markets, and I just want to point out the sentiment in the market. I spoke to you about people have returned to a period of nonchalance, especially in the media, and we see that the VIX is currently at the 14.02 level. Not historically the lowest level we have seen. The lowest level that I have on this chart is at 860. That was in 2006 when the VIX bottomed, pretty much close to when the market topped out. Market topped out in 2007 the last time, but we have a relatively low VIX at this point in time, so everyone seems quite comfortable with the market. But just keep in mind that the bull market in the S&P 500 started back in 2009. Let me just bring up the chart here. It's a monthly chart of this bull market. Bull market started in March 2009, and the market has run up ever since. We are currently in March 2016. So, folks, this bull market cannot last forever. Markets just don't go up forever and ever and ever. Are we at the top? The market is looking like it could be in the last 10% or so of the move to the upside. So, as a smart investor, what you should be looking out for, and what I am certainly looking out for and preparing myself for, is if the market starts to decline, where will your portfolio be positioned? Will you have a diversified investing strategy, or will you just have an equity only strategy? Because I find by speaking with folks, they have a lot of positions that are just marked in equities alone. And I believe that the best way to invest, the best way to ensure that your portfolio continues growing and to position your portfolio to grow, is to have a more diversified approach, a diversified trend following approach. So we identify trends in the market and we hop aboard the trend in the market. And what I mean by diversification, essentially, if we have a move in the gold market, let's say gold has bottomed out and gold starts to rise or continue to rise in 2016 here, a prudent strategy is to position yourself to take advantage of the move in gold. This has historically not the greatest correlation to the equity markets, the gold market. This is what I mean by diversify strategy. Diversify yourself into different asset classes and not just equities alone. So if equities start to move to the downside, for example, in 2008, folks lost 70, 80, 90% of their portfolio in a couple of months. But a more diversified investing strategy that took advantage of different markets would have seen you could have not only avoided some of those losses in the stock markets, but taken that, but position yourself in markets that actually performed. For example, in 2008, we saw a run up in the US dollar. While the stock market was not doing that well, we had the US dollar increase just about 20% in the months of the crisis. And this is a monthly chart of the US dollar index moving up from 70 to just shy of the 90 level while the crisis was occurring. So a good portfolio would essentially have positioned yourself to take advantage of that up move in the dollar and get out of equities. Okay, so that is what I have for today with the Smart Investor podcast. Remember, we'll always keep you ahead and keep you abreast of what's happening with the price analysis in the markets, because oftentimes why investors lose a lot of money in the markets is that they are caught flat-footed sometimes and do not pay attention to what exactly is going on. By keeping listening to the podcast, we will definitely keep you abreast of the price analysis. Thank you very much for listening, and this is Beyond signing out, and I hope you have a wonderful investing week.